target that we've set ourselves is to offer a booster to everyone eligible by the end of January.
We all had thought that this winter was not going to be straightforward.
The word transitory, I think it's probably a good time to retire that word.
This is Bloomberg Surveillance, early edition.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Here's what's coming up on today's program. Jay Powell turns hawkish. The Fed chair ditches the word transitory and says he's open to faster tapering. Boris Johnson urges hospitals and pharmacies to ramp up boosters. The UK races to expand the vaccine rollout on Omicron fears. Closing the loop, Bloomberg learns that China plans to ban a loophole used by tech firms for foreign IPOs. Well, first, let's get a check on the markets. After a pretty severe sell-off yesterday, we are looking at a decidedly risk-on market. We have the Europe Stock 600 up about 0.7%. Similar story when it comes to U.S. futures as well. It was a positive handover from Asia. Those jitters over higher yields not hitting stocks today. Is it dip buying? Is it more optimism? Or are we just going to end up selling this rally? Well, we are looking at the two-year yield up by another 4 basis points today. Yesterday, seeing a gain of more than 13 basis points in the span of just half an hour after Jay Powell's testimony really shows you the extent of whiplash in this market. Now, we're also seeing Brent crude up almost 4% as well. We have an OPEC Plus decision on deck. We'd seen Brent crude enter WTI had entered a bear market yesterday, so a bit of a rebound in that as well. And finally, worth pointing out the dollar lira, that is up 1%. So, of course, it means that the lira is declining, reaching an all-time low versus the dollar over Erdogan continuing to call for more rate cuts. So here is your map markets go on your terminal, and it is all green. Some of the bigger outperformers you will notice is the FTSE 100. That's up 1.3%. A lot of the oil majors live here. I was showing you before how oil outperforming today, those prices moving higher, so really helping a lot of those energy names. We also have the DAX up more than 1%, Kakaron up almost 1% as well, and the IBEX up 1.2%. Now, let's stick with that main story today where Jerome Powell has ditched the transitory tag for inflation.
The word transitory has different meanings to different people. I think it's probably a good time to retire that word and try to explain more clearly what we mean. The word transitory has different meanings to different people.
Acknowledged that before the Senate Banking Committee that price pressures are more powerful and persistent than he had expected. And crucially, he said that policymakers should weigh tapering their bond purchases at a faster pace. What does that mean for markets? Hear what some of our guests think.
The market was really just waiting for him to retire that term, right? Because actually the market had already been pricing in that they would be tapering faster than they had initially announced.
This is still going to leave us in very loose monetary policy territory.
There's variants out there from obviously COVID, and those variants will continue. And this is the playbook for 2022 and 2023, not going away. So markets have got to adjust to it.
It's arguably kind of reinforcing some of the market biases around when the Fed is likely to lift off next year.
This should give the Fed options. They had stressed about wanting to have this flexible average inflation targeting.
We shouldn't be panicking about either Omicron or the Fed.
Well, let's add another smart voice to the mix. We're joined now by Rupert Harrison, Portfolio Manager in the Multi-Asset Strategies and Solutions Group at BlackRock. Now, Rupert is a member of the government's Industrial Strategy Council, and his previous roles include Chief of Staff to George Osborne and Chief Economic Advisor to David Cameron. Rupert, really great to have you on the program and have you on the studio as well. So I want to get your first initial take on this so-called Powell pivot. How surprising was it?
I don't think it's very surprising because I think the Fed have been pivoting in this direction for the last few months, given the inflation news. I think the market pricing is now pretty full. I think we expect that actually as the kind of shift in goods price inflation eases a little bit next year, and as we see some of that shift back towards services demand, we'll get a little bit of easing of pressure on the inflationary front. But I think that this is now, the new normal for the Fed to be very focused on this inflationary pressure. I think they're under an enormous amount of pressure on that issue. But as I say, I think the market pricing for tapering and liftoff is now pretty full, so I would be looking to fade that, if anything.
Okay, so this isn't the start of a taper tantrum then?
I don't think so. I think, look, there is going to be a kind of complicated profile to the inflation dynamics over the next couple of years. I think we are very close to a peak of the short-term inflation dynamics, at least over the next couple of months. It's possible that Omicron will maybe push that a little bit to the right. And then we're going to see some of that goods price inflation likely fading next year. We'll take some of the pressure off. At the same time, we have a very hot labour market building in the US. That's a much more slow-moving development, and I think over the next 2 to 3 years, that's going to kind of keep a kind of floor under rates in the US and force this kind of gradual liftoff. But I don't think it's going to be a kind of sudden kind of emergency pivot again from the Fed next year.
Right. Well, I mean, you mentioned the BOE, and I've seen some comments floating around, perhaps comparing communication between Andrew Bailey and Powell, and perhaps mistakes that were made. One that really stood out to me, if I can read you this quote from Tom Porcelli over at RBC and get your thoughts on it. He says that Powell should have expressed his current level of worry about inflation many, many months ago. He's doing it all backwards. He made a real mess of the entire conversation, and it's something that doesn't instill confidence. Is that a fair criticism?
Well, look, I think that central banks have understandably struggled with the inflation dynamics, as have markets. I think we've never been in a situation like this, and therefore we have seen some bumpy communication from all central banks, I think particularly in the UK. I actually don't think it's fair to say that the Fed has only just started talking about inflation. I think this has been a pretty clear pivot over the last few months. I think the Bank of England had done maybe a slightly more kind of screeching U-turn that it's now, again, dialed down a little bit. But the direction of travel now is very, very similar, and I think it's generally understandable given the very unusual dynamics that we're seeing in inflation.
So then if the market perhaps reacted with a little bit of overreaction maybe to what, as you say, was a clear path laid out before, would you be a buyer of yesterday's dip?
Look, I think that the Omicron developments are still justify a kind of holding pattern for markets in terms of risk sentiment. I think that it's a setback. It's certainly not setting us back to square one, given all the progress. We've got to bear in mind progress on vaccines, antivirals, the fact that many, many governments are not going to go back to the kind of lockdowns that we've seen before. But at the same time, I think we have to expect some kind of serious vaccine escape from this variant. We will obviously, there's uncertainty around that. We'll find out about that in the next couple of weeks. And that is going to delay the recovery over the winter. It's probably going to mean a new booster program with updated vaccines. That's going to take some time. And I think we'll see the same kind of dynamics where it'll put a premium on countries that have good vaccine infrastructure in place and will mean more of a setback for countries where that isn't in place. And I think that we're going to see that in Europe in particular over the winter. So
considering all of the headwinds we could potentially have, and as you say, there's so many unknowns at this point, and you are worried about market gyrations, what serves as a useful hedge right now?
Well, look, we've seen duration and government bonds coming back into fashion as a hedge. They have actually been working over the last few weeks. That's something we've been adding back into portfolios over the last few months. So I still think that for a multi-asset portfolio, government bonds are still an important part of that mix. I think the dollar is an important part of hedging multi-asset portfolios at the moment. Interestingly, we haven't seen that in the kind of extreme risk-off days over recent days where you've seen the dollar weakening. But generally, I think the trend towards a stronger dollar, and I think that over a longer horizon, that will still act as a decent hedge, particularly as you see these longer-term inflationary pressures building in the US much more than elsewhere, particularly in Europe.
Yeah, King Dollar sticking around. Rupert, you're going to stick around as well. We have much more to discuss. That's Rupert Harrison from BlackRock. Now, smart conversations continue on Bloomberg Surveillance Early Edition. Bank of London CEO Anthony Watson and Amadeus Capital CEO Ann Glover joins us later this hour. But up next, we're going to continue the conversation, as we're saying, with BlackRock's Rupert Harrison. If you have any questions for him, any of our guests, send those on IB plus TV Go. This is Bloomberg.
The target that we've set ourselves is to offer a booster to everyone eligible by the end of January.
All right, that was UK Prime Minister Boris Johnson announcing boosters by the end of January. Well, Rupert Harrison from BlackRock is still with us. Rupert, I do want to tap into your many years of policy experience here and get your reaction and your take on the UK really trying to speed up its booster program as well as enforcing various restrictions.
Well, look, the principal goal, I think, of the government in the UK is to avoid having to impose more serious restrictions. We've already seen that in Europe. I think that would be politically very difficult for Boris Johnson in the UK. Happily, I think we're in a relatively good position. The fact that the UK has had a successful vaccine rollout, I think we're really now starting to see the booster program step up. And hopefully, if we can hit those kind of 500,000 a week type levels on boosters that we saw at the peak of the kind of first vaccine program, then that can roll out very, very quickly. And then combined with the fact that we've had quite a kind of rolling, persistent wave of cases over the summer and the autumn, they're giving that kind of higher natural level of immunity. The UK looks relatively well placed. But of course, we're all waiting for the news that will come in over the next couple of weeks about the extent of immunity escape that we're going to get from this Omicron variant.
Right. I have a feeling there's going to be that tinge of uncertainty probably over everything that is being discussed right now. And I know that in November 11th, I was reading shortly before the show an op-ed you wrote in the Evening Standard talking about, reasons to be cheerful about the UK economy. Does any of that view now have to be revisited, or is it more uncertain now given the presence of a new variant?
Look, I still think that the fundamental case remains the same, right? We are looking on a kind of 6 to 12-month horizon at an economy where inflation is going to come off from the peak, where household balance sheets, corporate balance sheets are pretty strong. The policy environment is still broadly supportive, even though we're going to see some policy tightening. I think Omicron has the potential to push things to the right. So both on growth, where I think we will see behavior changing, even if we don't get locked down. So we're going to see some of that services sector activity probably fall back over the winter, pushing some of that recovery to the right. And on inflation, where I think you could see the peak of inflation also pushed to the right, particularly if some of these supply chain pressures are exacerbated, if some of that fallback in goods price inflation is delayed. So maybe push to the right, maybe a bit of delay, but I still think the fundamental picture is a good one on a sort of 12-month horizon.
Right. And one of the other sort of pictures for the economy that perhaps clouds this view as well is the energy crisis. We were discussing this during the break. It hasn't gone anywhere. Yeah, look, absolutely. The focus over the last few days obviously been on Omicron and the market moves that it's generated, as well as the Fed. This energy crisis, particularly in Europe, I think is still a very real problem facing us over the winter. We've seen oil prices fall back down, but we've seen wholesale gas prices still at record highs and rising. We still face a significant problem with low storage, with the latest temperature forecast for the European winter are looking pretty cold. And also, particularly if we get people working from home, we saw in 2020, you saw a pretty rapid drawdown of storage in that winter because you're having to heat the offices and the homes. And so you're going to kind of pick up in demand as well. I do think that the potential for sort of significant industrial disruption in Europe over the winter hasn't gone away. It's one of the reasons why we would favour sort of defensive sectors in Europe over the next few months over some of the more cyclical sectors, particularly the big energy consumers. I think that is a big risk. Do you think and do you anticipate more government intervention to deal with the energy crisis? Yes, look, governments are struggling. There's only a limited amount they can do. The storage situation can't be solved overnight. You've seen governments across Europe take different measures to try and protect consumers. I think you'll continue to see kind of piecemeal measures to try and do that. There's going to be a particular crunch moment in the UK in April because, of course, we have this energy price cap for households that is going to be reviewed then, potentially with a very steep increase. So, again, the UK's inflation profile might look different from some other countries because households that are being protected at the moment are going to see a big jump up in their energy prices in April. So some pretty big challenges for policymakers. Rupert, I'm going to do a particularly hard pivot, so just bear with me for a moment here. Just seeing a headline cross a Bloomberg terminal that Turkey's central bank is intervening in the FX market to stabilize the lira. This, of course, comes after the lira hitting record low after record low. Erdogan calling to continue to cut rates. Your take on EM generally, and is this a market that you would touch? Turkey is not a market I would touch. I have to say, I don't think this is looking like it's going to end in a good outcome. I don't think the policy framework or the political will is there to deal with what needs to be done. I think we are looking, very likely to see Turkey looking to some external support in order to try and resolve this medium term. EM generally, I think, is still suffering. I think China is still very sluggish. I don't think I would expect to see a big bounce back in China. And so the kind of whole China complex, I think, is still going to be relatively subdued. And of course, what we were just talking about with Omicron, again, this is a setback for emerging markets because, again, they don't have the kind of good vaccine infrastructure in place. And also, I think some of the Asian countries where you've still got a kind of zero COVID or very low tolerance for COVID, we could see some restrictions kicking back in. For the rest of the world, I think that could have an impact, for example, chips and semiconductors,
we could see, again, that problem worsening if we see restrictions kicking in some of the big producing countries there.
Fair enough. Rupert, it was really great to have you on.
Thank you.
Wide breadth of topics we were able to cover despite all of that uncertainty. Thanks so much. That's Rupert Harrison, Portfolio Manager in the Multi-Asset Strategies and Solutions Group at BlackRock. Now, let's get over to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne. And let's get to that first word news as Leanne gets settled in. Germany's incoming chancellor has indicated his support for making COVID-19 vaccines compulsory. Olaf Scholz called for a parliamentary vote on the measure before the end of the year, saying he would allow lawmakers the final decision. A mandate would be a major step for the new administration as it seeks to increase Germany's relatively low vaccination rate of less than 70%. The U.S. and Japan are among countries planning tighter measures for inbound travelers to help combat the Omicron variant of the coronavirus. Meanwhile, the Indian state, which is home to Mumbai, has imposed quarantine for passengers arriving from at-risk countries. In Europe, France has reported 47,000 new cases of COVID in the last 24 hours. That's the highest level since April. The European Union plans to mobilize 300 billion euros in public and private infrastructure investments, that's by 2027, to offer to developing countries. Bloomberg understands the EU's Global Gateway program, which will be unveiled today, will outline spending on digital, transport, energy, and health projects. The plans are being seen as an alternative to China's massive Belt and Road program. Tel Aviv has leapfrogged Hong Kong and Singapore to become the world's most expensive city to live in. That's according to a report by the Economist Intelligence Unit. The Israeli city climbed from 5th place last year to top the worldwide cost of living survey for the first time. It pushed down Paris to 2nd place, joining it with Singapore. Rome saw the biggest drop in the ranking from 32nd to 48th place. Global news 24 hours a day on air on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Well, coming up, closing the loop, as we're just discussing, a lot of news coming out of China, and Bloomberg also learning that China plans to ban a loophole used by tech firms for foreign IPOs. That's next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Now, China's crackdown on foreign IPOs may be reaching its conclusion. Bloomberg has learned that Beijing is planning to close the loophole used by tech firms to list abroad. New listings via variable interest rate entities, VIEs, which has allowed firms like Alibaba and Tencent to sidestep rules on raising capital overseas, will now be banned. And companies already using VIEs in the U.S. and Hong Kong will have to improve their transparency. Let's get more on this now with Candice Zacharias, who broke the story. Candice, really fantastic scoop from you and the team here. So what's driving the latest changes to these offshore listing rules being mulled by China?
Hi, Danny. Thanks for having me on. It might be surprising to some, but till recently, China had very little legal recourse if it wanted to stop a Chinese firm from listing overseas. As we saw with the ride-hailing giant Didi and its New York IPO recently. A lot of firms, particularly in the tech world, would raise foreign capital and list offshore using units incorporated outside China in places like the Cayman Islands. And as you rightly pointed out, that was called the variable interest entity structure. It's this structure that's now under fire. Sources tell us that China plans to ban the use of VIEs for foreign listings with an eye to addressing concerns over data security. Firms using these structures can still pursue IPOs in Hong Kong, but even these will need regulatory approval. So effectively, what we think these changes would mean, if they come to pass, is that the VIE model will no longer be a viable way for many startups to tap capital markets. And as you said, for listed firms, it means making adjustments so that their ownership structures are more transparent in regulatory reviews. What could this mean? It's not quite clear now exactly what shape this would take, whether it will mean overhaul of shareholders or more drastically a delisting of the most sensitive firms.
Right, and this isn't the first time we've got concern about listings in China and tech firms in particular. Candice, how does this fit with that ongoing crackdown on tech in China?
It's all part and parcel of what's now been a year-long crackdown on the technology sector in China. We know Beijing is exerting greater control over its tech firms after decades in which they were allowed to expand almost without too many curbs. These firms, though, have become such an integral part of every aspect of Chinese life, and they've amassed reams of data, which are now becoming an increasing national security concern for China, particularly given the tensions with the U.S. Beijing has also said it wants to curb what it calls a reckless expansion of private capital, and the tech sector is an obvious target here, given the wealth generated by company founders like Jack Ma and Tony Ma.
All right, Candace, thank you so much for keeping us on top of this story. Again, a fantastic scoop by you and the rest of the team. That's our Asia and Finance Investing Managing Editor, Candace Zacharias. Now, Smart Conversations are going to continue on Bloomberg Surveillance Early Edition. Amadeus Capital CEO Ann Glover joins us later this hour. But up next, we speak to Bank of London CEO Anthony Watson. If you have questions for either of them, you want to go to IB Plus TV Go as we continue to see a decidedly risk-on mood to these markets. Our last guest saying that it wasn't that big of a surprise to see this pivot from Powell, maybe markets adjusting to that new reality as well. We'll continue the conversation next. This is Bloomberg. Jay Powell turns hawkish. The Fed chair ditches the word transitory, says he's open to faster tapering. Boris Johnson urges hospitals and pharmacies to ramp up boosters. The UK races to expand the vaccine rollout on Omicron fears. Closing the loop, Bloomberg learns that China plans to ban a loophole used by tech firms for foreign IPOs. Good morning. Happy first day of December. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Let's get a look at your markets today because they are seeing a bit of a turnaround. That is from yesterday's selling pressure. We're looking at a Stocks Europe 600 that's up nearly 0.9%. That mirrors closely what's happening in the U.S. Gains on the S&P 500 index also of more than 1%. We were just talking to BlackRock's Rupert Harrison, who was talking about that. This is the direction that the Fed was going in, this more concern about inflation. So markets perhaps adjusting to that new reality. We still are seeing this pretty tremendous move in the front end of the curve. It is up about 3 basis points, 5 years up 6 basis points. Crude also on a tear today. But one of the assets we're continuing to keep our eye on is the Turkish lira. It continues, or rather had seen some all-time lows versus the dollar. That started to turn around. A red there, of course, means the lira is gaining because we're looking at the dollar-lira pair. This is after lines saying that Turkey is looking at intervening in the currency. Well, let's get back to that top story with Jerome Powell, who has ditched the transitory tag. The Fed chair acknowledged before the Senate Banking Committee that price pressures are more powerful and persistent than he had expected. And crucially, he thinks that policymakers should weigh tapering their bond purchases at a faster rate.
The threat of persistently higher inflation has grown. The test that we've articulated, I think, clearly has been met now. Inflation has run well above 2% for long enough. The word transitory has different meanings to different people. It's probably a good time to retire that word and try to explain more clearly what we mean. You've seen our policy adapt, and you'll see it continue to adapt. You know, we will use our tools to make sure that higher inflation does not become entrenched. The economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner.
Well, from the central bank to a different kind of bank, a new clearing bank set up to approve and process payments has launched in the UK. And this is only the second time that's happened in 250 years. The Bank of London aims to compete with the big four UK banks that dominate this market by offering features including cheaper, faster, and safer transactions. It's recently held a fundraising round that valued the company at more than $1 billion. Pleased to say we're joined now by Bank of London CEO and founder Anthony Watson. And Anthony has also previously held executive roles at Nike and Barclays and founded a cryptocurrency trading platform called Uphold. Anthony, so great to have you on today's program. Congratulations on reaching that unicorn status as well. And this is pretty complicated stuff. It revolves around sort of the inner plumbings of the UK banking system. How do you come into this market relatively new and take on some of these huge name competitors that you're now up against?
Well, first of all, thank you so much for having me this morning. I greatly appreciate the time you've given us today. We've spent about 4.5 years working with the Bank of England's PRA and the FCA, sitting down with them, really understanding the challenges that's currently in the marketplace and how a new competitor could enter the marketplace and really challenge the status quo. So if you look at the 4 principal clearing banks of the UK, they're bloated, highly leveraged institutions with balance sheets, some of them in the trillions. 3 trillion, I think it is, HSBC. So their cost of capital, their cost of providing services is astronomically high, incredibly bloated. So relative to a startup like us, where we'll have 3,000 people at capacity, we also have patented innovations that cover the principal risk factors across payments, clearing, settlement, disbursement, and compliance. And so when you add these factors together, we believe we offer quite a compelling proposition to UK PLC.
We certainly hear a lot, things like cash management, a lot of businesses complaining about how slow it is to do that via sort of the normal banks. But as you say, these are really large entities. They potentially have the money to put into investment here. So what's stopping them from doing that, especially if they face an upcoming competitor like Bank of London?
That's a great question. So the primary issue for what I would call the heritage institutions is their cost of capital, but also their balance sheet costs. So, for example, if you look at an institution like a Barclays, I think it's just under 2 trillion balance sheet. They have the liabilities that the follow-on liabilities of a chain of issues that encumbers them. And so with an institution like the Bank of London that has currently over 100% tier 1 capital and 100% non-leveraged balance sheet, our model takes risk out of the system. Now, that doesn't mean we don't carry any risk. Like any company, we carry operational risk, but capital and balance sheet risk is not one of the challenges we have to deal with. So we can move money truly in real time without having trapped capital like nostro-vostro accounts around the world. The last estimate I read from McKinsey, and then again, this is quite a dark, opaque world. People don't talk about the real issues here. But if you look at the trapped capital that's just sat, like non-performing capital in nostro-vostro accounts around the world, it's about $20 trillion just sat there not performing. We don't carry those legacy issues. So we believe when you're a major corporation or a major institution that needs to move liquidity, access to liquidity and move it in real time, will be one of the only players that you can do that with truly. Because today, if you look at the way the system works, for example, let's say I was to send you £100 from my account in London to your account in New York, as an example. Barclays would send a SWIFT message to its correspondent bank, or JP Morgan, let's say. It would take money from its Nostro account and they'd give it to you. So you'd probably get it in 24 hours. The banks themselves don't settle with each other up to 40 days in some instances. And that's because of the legacy balance sheet and capital risks we just talked about, where we remediate that problem directly because we don't carry those liabilities.
All right, Anthony, I'll be looking for my my check in the bank account in that case. But I do wonder how you're going to be judging success starting out here. What sort of volumes, for example, are you looking for?
Well, we've talked to a number of participants. For us, this is a marathon. It's not a race. So we've spent, as I said at the start of the conversation, over 4 years getting our license. It's a unique license relative to our competitors in the UK. And so we see the next 2 years will take an interesting piece of volume. We view success, to get pointed to your question, we view success if we take a 3% market share over 5 years, we'll become a highly profitable business.
Anthony, I want you to also put on your hat from Uphold as well, the crypto trading platform that you founded. Do you see any use, or does crypto play a role in the Bank of London, or really these more traditional sectors of banking?
So we will work with any authorized participant in the marketplace, regardless of what type of participant that is. That being said, I don't, and this is someone who co-founded a crypto platform, a digital asset platform. The bigger issue for the space is it hasn't really lived up to the promise of freeing people to be able to move money. So, for example, with Bitcoin over $60,000 a piece, that's not really relevant to the man or woman in the street at all. And when you look at the cost to convert that Bitcoin, it's like 6 or 7%. So why would I go into a Ford dealership to buy a Ford Focus or whatever, and convert my Bitcoin into fiat, pay 6%, and then go buy my car? Makes no sense. The volatility that comes with that is astronomically crazy as well. It bounces around like a jackrabbit. So when you look at these factors, certainly I don't believe that crypto has lived up to its promise yet. So I think we're still a few years away of crypto actually transforming the system the way it envisaged it in its early days.
Right. Anthony, thanks so much for joining this morning. That's Anthony Watson, Bank of London founder and CEO. Good luck as you continue to grow. Now, coming up, investing in the metaverse, we speak with the CEO and co-founder of Amadeus Capital, Ann Glover, about the future of technology and VC in the UK. That's next. This is Bloomberg.
For us, that's next. We did offices collaboration. I think we all went through the journey of having video conferences like that in great quality and context. But the metaverse is the next big chapter, which I think is giving us a real capability to go augmented. We see that already in manufacturing a lot, where you have production sites being augmented on HoloLens capabilities, so remote services, that is already in place. But the real metaverse, where you actually combine physical and digital world, is a fantastic experience to come. Please be excited. It's coming soon, it's coming fast, and it's coming for all of us on our own choices and terms, but you really will be able to have digital and the physical world coming together as an experience.
Part of my conversation there with Ralph Hopter, EMEA president of Microsoft. And as he was explaining, we're seeing tech firms targeting the future of workplaces and social spaces. Investors have poured a net $106 million into the Roundhill-Ball Metaverse ETF since its launch in the summer of this year, and flows accelerating after the Meta platform rebrand. 4 new Metaverse-focused ETFs in South Korea have also seen double-digit gains since last month. Now, let's get to the tech conversation. Pleased to say that joining us is CEO and co-founder of Amadeus Capital, Ann Glover. Ann, so wonderful to have you on the program this morning. Good morning to you. We can dig into the metaverse in just a little bit, but considering that you are focusing on the tech space and the VC tech space here in the UK, I want to get your opinion on where the best place to find value is at this moment, considering that there's a lot of optimism around the space and a lot of richly valued assets.
Well, I always feel that the value is if something is not quite understood fully yet. So we are spending our time investing in deep tech. So in heavily IP-oriented spaces, new materials, very long-term, but still hugely important trends in terms of how it's going to change all of our world. So it could be instead of silicon chips, graphene chips, instead of plastics, biodegradable materials, those sorts of things. I think there's a lot of undervalued companies in that space, not just in software and social environments.
Well, when you look at these sort of AI, machine learning types of investments, which of course you're focused on as well, when you get more hype from the big tech names, the Microsofts, the Facebooks, what sort of traction have you seen in that market? Has that created more rich valuations, or is that still attractive as well?
No, it's still attractive. I mean, again, where we are playing is we're playing in the sort of B2B, the DevOps, and the sort of business applications as opposed to the consumer applications. I think consumer is overhyped. I think it's easier for investors to understand. They can see what a difference it's made in the world of during the pandemic. But actually, to make that work, you need a lot of picks and shovels. And so we have some very exciting companies that are going to be much more dominant, but you're not going to know their names until they actually, frankly, get sold or listed, because they're not consumer names. So it's very exciting, and there's some great talent in the UK. And we have a few companies that we think will dominate, for example, the DevOps space in the delivering machine learning models to users across the globe. So we're really excited.
I wonder about some of these areas that might be under a little bit of stress in tech. And I think specifically of software. We had Salesforce earnings yesterday. Their forecast disappointed. There was perhaps some suggestions that companies aren't spending as much on IT as we worry about the new variant of COVID. Are you seeing something similar as well?
No, those reactions, you don't get a reaction like that so instantly. I mean, these software adoptions take months to be put in place, and the COVID variant's only just been announced in weeks. So you'll see investors react that fast, but if you're looking at the actual bookings and sales pipeline, it'll be a lot longer in terms of lagging. I don't think that if there is a softness, it's to do with that. I think it's to do with business investment and worries about inflation. I think that's been the backdrop that people are deciding whether or not they can afford to make major business investments now, including in software. So I don't think it's got a link to the variant at all. Investors may do so, but I don't think customers will.
How big is rising inflation as a threat to your outlook?
I don't think it's much of a threat to the tech space at all. Tech in general is deflationary, and it lowers the cost of doing things. And so because of that, it's if people have the cash and the risk appetite, then they are going to continue to invest. So it's more about risk on, risk off than it is about inflation. And so I think that as long as there is cash around, and there is a lot of cash around, for people to make investments in new business initiatives, I'm not worried about the tech space. The valuations may come down because the environment will be less frothy, but I don't think that the growth will change.
And you had mentioned before about the growth of tech in the UK and the success there. We had a story today about Blue Prism, the UK tech company, being bought out by SS&C, of course, a US company. There's been a lot of US interest, certainly, in UK tech. Is that a trend you expect to accelerate, or do you think at-home growth and staying at home is the future for the sector?
Look, I hope it's both. I honestly believe that really great companies who have big visions deserve to stay independent. And the London Stock Exchange has spent a lot of time trying to attract and keep domiciled companies here, whether it's Wise or hopefully Revolut So I think we need a capital markets ecosystem that supports us, but it will also be true that because there are leaders elsewhere in the world and that they see value in UK technology, because frankly, there are world-leading companies here that in the end, the entrepreneurs and the shareholders will sell in order to, frankly, maximize their short-term profit, but also, frankly, the future of the business. I mean, we ended up selling a company called Solexa to Illumina, and it's now 90% of Illumina's sales. So you're going to see both. What I would really not like to see is that it's only a US acquisition as the option.
Right. And I'm afraid that's all we have time for. Really fantastic to have you on the program this morning. That's Ann Glover, CEO of Amadeus Capital. Thanks so much for joining. Now, I want to give you a quick check on what your Turkish lira is doing today. The U.S. dollar lira spot dropping 5.8%. So, of course, that means a gain of nearly 6% for the lira versus the U.S. dollar. This came just after we saw gains in the dollar versus the lira that had sent the lira to its lowest price on record. So what's causing this? we had the Turkey central bank starting an intervention in the future FX market, selling foreign exchange for the first time in 7 years to try to stem some of these declines. Erdogan also saying that he will never be in favor of interest rates. So Erdogan just continues to try to enforce these interest rate cuts. That's why we had seen losses in the lira, but of course reversing quickly as we get this intervention from the central bank. All right, well, let's get your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Danny. UBS has named JP Morgan banker Sarah Youngwood as Chief Financial Officer as the Swiss lender seeks greater diversity among top management. Youngwood has been CFO for JP Morgan's consumer and community banking business since 2016. She'll join the UBS Executive Board at the beginning of March and formally take over as CFO in May. Now, China is said to be planning to ban companies from going public on foreign stock markets through variable interest entities. Bloomberg understands Beijing wants to close the loophole partly to address concerns over data security. The route has long been used by the country's tech industry to raise capital from overseas investors. Brazilian digital bank New Holdings has trimmed the valuation of its IPO while also attracting the interest of SoftBank. Its proposed price range of $8 to $9 per share values the Warren Buffett-backed startup at almost $42 billion. Nubank plans to list Class A shares on the New York Stock Exchange while also offering Brazilian depository receipts on the Sao Paulo Bourse. And that's your Bloomberg Business Flash. Danny.
Leanne, thank you very much. All right, coming up, Europe is set to unveil its Global Gateway program today, and it's looking to rival China's Belt and Road. But can the bloc match Beijing for the investment? We're going to have more from our Maria Tadeo, who's live in Brussels. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. We continue to monitor the lira, which is now flipped to gains. It's now gaining about 3% versus the U.S. dollar. Previously, just hours before, it had been charting an all-time low. So to put this in context, it still is really weak. What we're looking at the moment are live pictures of President Erdogan speaking. This is following the Turkey central bank, which has said it is intervening in the FX market. The goal here is to stabilize the lira. That's why we've seen lira flip to gains. But Erdogan, as he's been speaking, some of those gains starting to ease off slightly. He has said that they've abandoned monetary policy based on higher rates. So really enforcing that he doesn't want to see higher rates. That low rates is the future for Turkey. He also says that Turkey's new path may be risky, but he says it is correct. So President Erdogan, you're watching there, live pictures of him speaking as we look at the volatility in the lira, seeing a very strong day versus the U.S. dollar. But again, we have to put this in context. We've seen all-time lows in the lira over this move to keep interest rates low. Well, let's now turn to the European Union, which is set to unveil its Global Gateway program today, in which it will seek to mobilize 300 billion euros for public and private infrastructure investments, all of this by 2027. The program is Europe's parallel to China's Belt and Road Initiative, which begun in 2013. Joining us to discuss the details is our Europe reporter, Maria Tadeo. So, Maria, very quickly here, just 30 seconds. Is this Europe's attempt to extend its influence in the world?
Well, it's a tough ask in 30 seconds. So to give you the short answer on this is yes, that's essentially what they're trying to do, to say we can also go out to a lot of developing countries to help them with key infrastructure and provide funding. Of course, there's a vested interest for the European Union to do this. You're looking at trade links. You're also looking at your own supply chain coming together.
All right, Maria, sorry to hurry you there. Fit it all in the nick of time. That's our reporter in Brussels, Maria Tadeo. Thanks for joining us. That's it for us, or at least it for me. Bloomberg Surveillance Early Edition is going to continue the next hour. This is Bloomberg.
Fed is in a catch 2022 next year. They can't be too dovish. Inflation is going to bite.
At the moment, the Fed kind of seems reactive to these numbers rather than getting out front and saying to markets, hey, it's going to be bad, it's going to be worse.
The word transitory has different meanings to different people. I think it's it's probably a good time to retire that word.
This is Bloomberg Surveillance, early edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It is 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, December the 1st. Our top stories today. Jerome Powell turns hawkish. The Federal Reserve Chair signals tighter policy. Stocks initially fell, but now rebound in Europe and on U.S. futures. Tougher travel rules. The White House is set to impose new restrictions on travelers to fight the spread of the Omicron variant. And China is closing a loophole. Beijing plans to crack down on tech companies that want to go public on foreign stock exchanges. Good morning, everybody. Welcome to Bloomberg Surveillance, the early edition. Kailey, we begin with some breaking news then. The OECD just published its latest economic outlook. Whilst we're all focused on the virus, focused on Powell, we need to not lose sight of the forecast for the economy.
Yeah, and those forecasts are moving lower, Anna. The OECD downgrading its world GDP forecast for 2021 to 5.6%. The previous forecast was 5.7%. They also cut the forecast for the U.S., China, and Euro area for both this year, 2021, and next year, 2022. They say that there's more downside risks than upside ones to the outlook, and that central banks should wait for supply tensions to diminish. So interesting to contrast what we're hearing from the OECD here versus what we heard from Chairman Powell yesterday, and the idea that the Fed is going to taper more quickly. And of course, that is something that the markets continue to digest. However, we did see actually some risk appetite in Asia for the first time in about 3 days. The MSCI Asia Pacific Index did rise about 1%. That said, there were some underperformers within that. It was actually the Philippines, which opened back up after a holiday, and sharply to the downside did they open back up. That index closing lower by 3.5%, as you're seeing the extension of curbs there in order to stop the spread of COVID-19, the Omicron variant, obviously creating some problem across the world, really. And now, while you had underperformance there, you had outperformance actually in South Korean equities and in FX. The South Korean won, the big outperformer in Asian currencies, stronger against the dollar by about 0.75% after some strong export growth data. And the Japanese yen is actually a laggard today, not really getting that haven bid. It is weaker against the dollar, trading at 113.46. As for the picture here in the U.S., those remarks from Chairman Powell and concern about the variant did take stocks lower yesterday. We are seeing some buying of the dip. This morning, though, traders seem to be looking past that hawkish tone from the Fed chair. S&P 500 futures right now up about 1.2%. You are seeing yields moving higher, up about 5 basis points on the 10-year to 149.54, so still south of 150. But you're seeing more movement at the short end and the belly of the curve as the market reprices its expectations for when the Fed will lift off. And as a result, you're seeing the flattest curve since all the way back in March 2020 when it comes to the 5/30 spread, which right now is sitting at just 61 basis points. And finally, oil getting a nice rebound today after more than 5% loss yesterday. WTI crude up about 4.4%, trading at 69.10 as we look ahead to that OPEC Plus decision tomorrow, Matt.
Yeah, big bounce for oil on both sides of the Atlantic. I should point out Brent crude is up over $72 again. No Omicron concerns in these markets, or at least maybe they've been priced in. We see big gains in Italy up 1.6%. The DAX here in Germany up 1.6% as well, and gains of more than 1% pretty much everywhere in Western Europe, with the exception of Portugal. It's only up 0.4%, but the UK is gaining 1.5% almost as well. If you look at the currencies, you also see a little bit of a change from yesterday. We had a stronger euro and a pound for most of the day. Now we have a weaker euro against the dollar at 113.31, still at relatively low levels, and the pound at 133.15, still gaining ground against the dollar. Here's Brent, as I mentioned, and if you take a look at the Turkish lira as well, that's also a very interesting currency. And as the Turkish government is now intervening in markets, and so you'll see, may see some movement there. We did see the lira, of course, fall to another all-time low against the dollar.
Yes, and this has been pushing the lira a little bit higher at the margin after, as you say, that all-time low. So the Turkish Central Bank has intervened in FX markets. We've learnt that over the last 45 minutes or so. But President Tayyip Erdogan still speaking, and we're bringing you live pictures of that. He's saying that he will never be in favour of interest rates, says Turkey's new path will be risky, but is correct. He also says that, well, he's warning those who are implementing excessive prices in Turkey and urging Turkish citizens not
not to panic and think about the long term. We had seen, as I say, the lira gaining on the FX intervention, but then pairing some of those gains. Turkey will never entrust its future to the IMF again. One of the lines coming through from President Erdogan. We'll continue to monitor what he's saying there in Ankara in Turkey. Now let's look ahead to some of the other things on our radar for today. It is day 2 of Powell and Yellen. The Fed Chair and Treasury Secretary are speaking once again, this time in front of the House Financial Services Committee. At 10:30 a.m. New York time, we'll get the EIA crude oil inventory report. Such a lot of focus on the oil market, so volatile, heading to that OPEC meeting. And the World Aviation Festival kicks off today in London. We've been hearing from Guy Johnson on the ground there already. We will continue to visit that event to speak to airline CEOs about the latest travel restrictions. A couple of really interesting US aviation CEOs speaking to us this hour. Kailey?
All right, well, Anna, markets are adjusting to a more hawkish Jerome Powell. The Fed chair made a clear shift in tone when he spoke to Congress yesterday.
The word transitory has different meanings to different people. I think it's probably a good time to retire that word. The economy is very strong and inflationary pressures are high, and it is therefore appropriate, in my view, to consider wrapping up the taper of our asset purchases, which we actually announced at the November meeting, perhaps a few months sooner.
Bloomberg Markets reporter Justina Lee joins us now. So, Justina, markets didn't take this well yesterday, seem to be doing better this morning. Are they just absolutely befuddled at a more hawkish Fed and also uncertainty around the Omicron variant?
Yeah, I think like on one hand, we're seeing markets kind of trying to digest the impact of that statement today. And I think, it's worth remembering that historically, monetary tightening hasn't always been bad for equities. And I think it really depends on the economic conditions. And on that front, we did get some better PMI numbers out of Asia today. So maybe markets are still kind of like pondering what this all means put together.
Yeah, it's a really interesting one, isn't it? Thinking about the extent of the rebound we're seeing today, despite what we heard hawkishly from Chair Powell. Let me ask you about something else, what we've just been discussing, in fact, and that is the movement in the Turkish lira. We saw strengthening on the news that we were seeing FX intervention, but those gains being pared back now. What is it that you think still dominant in the market's thinking around Turkey and around this currency, then, Justina?
Right. I mean, obviously we're seeing a bit of an effect from that intervention today. But at the same time, President Erdogan is kind of doubling down on his stance so far, which is that lower interest rates are good for the economy and let's not worry too much about the currency. And I think on that front, given that this really has been what's been pushing the foreign exchange rate down, I mean, I think it's kind of hard to say whether this really will be enough to kind of change expectations.
Yeah, it's important to repeat that his stance is that lower interest rates fight inflation, which, if you know it already, maybe it's getting a little bit old, but if you didn't, it's still exciting to hear that someone believes that. Bloomberg's Justina Lee joining us there on the markets. Let's get down to Washington, D.C. right now. The U.S. and Japan are among the countries ready to impose new travel restrictions to ostensibly restrict the spread of the Omicron variant. Scientists that don't work for politicians say that that's not how it works. But President Biden is expected to require all air travelers to the U.S. to be tested within a day of their departure. Emily Wilkins, Bloomberg government reporter, joins us out of Washington, D.C. So it looks like we're going to see even more restrictions at the airport, Emily.
Yep, that looks how it's headed. We're going to be seeing more information on this tomorrow from President Biden when he gives his address about how the administration plans to tackle the Omicron variant as it goes into the winter. But at this point, Bloomberg has learned that they are going to be reducing that window of testing before a traveler comes to the U.S. Used to be 3 days. Now it's going to be down to 1. That is on top of the travel ban for South Africa and the 7 surrounding countries. And there could be more to come. The big question mark right now is exactly what kind of threat does the Omicron variant pose? Are people who are vaccinated safe? How fast does it spread? These are things that we still don't know the answers to yet, and it's going to take a little longer for the research to come out so that government can appropriately respond.
Certainly could disrupt holiday travel. But before anyone can travel for the holidays, at least anyone in Congress can travel for the holidays, Emily, they have a lot of items on their agenda that they have to get through, including avoiding a government shutdown in the coming days. What is progress looking like?
So we heard last night from Democratic officials in the House that they do want to move today on a short gap spending measure that will avert a shutdown and take government funding into about January of 2022. We still don't know yet what that final date is. We don't know yet when. We haven't seen a bill yet. We don't know yet what could potentially be included with it. But this is something that lawmakers have said they just need time to do because they're also wrangling with that debt limit that they're going to have to address before mid-December, as well as they want to get through President Biden's social welfare and tax plan. A Majority Leader Chuck Schumer in the Senate has said he wants to get that done by Christmas. So a very packed December for lawmakers, but the first thing they have to do is make sure they're avoiding that potential government shutdown this Friday, and the House is hoping to move legislation today to address that.
Emily, thanks very much. Emily Wilkins of Bloomberg Government joining us there in Washington. Now, a Bloomberg scoop. Beijing is planning to ban foreign listings that use units incorporated outside of China. Bloomberg sources say the new rules could be finalized as soon as this month. This would close a loophole long used by the country's tech giants to enable them to list abroad. Bloomberg's Tom McKenzie has more details on this. Tom, good morning. So what's driving the latest changes to offshore listing rules being considered then by China?
Well, there's so much of the policy making out of Beijing now is and should be seen through the prism of national security, and it comes down to the question of data and the fact that China's internet companies are prolific now across that economy. Chinese policymakers are very concerned about what happens to that data of their citizens and their companies. So it is very much tied to that. What we know is that this is an entity, this was a structure using offshore entities, offshore jurisdictions and shell companies to allow these companies since about 2000 to raise capital overseas, foreign capital, and avoid the restrictions that have been put in place for a long time in China around restricting foreign investment in companies that are deemed to be sensitive, and internet companies fall into that group. So you could see potentially delisting of the most sensitive companies listed in the US. We'll see if that happens. But of course, implications for the likes of Tencent, Alibaba, they're going to have more transparency when it comes to the oversight from Chinese regulators, and possibly as well ownership structure changes.
OK, so this is all about variable interest entities, Matt.
Well, what does this mean? Oh, wow. We're hearing about variable interest entities again. What does this mean for ByteDance, the operator of TikTok for the kids globally?
Yeah, ByteDance, of course, the owner, as you say, of TikTok in the US, Douyin in China. They had, up until pretty recently, wanted to have the optionality of listing in the US. That now looks pretty unlikely. We'll see what they or their bankers may have to say, or what scoops we can get on that front going forward. The option for listing in Hong Kong is very much still there, even with a VIE structure. They've made that clear, but there will still need to be more oversight from Chinese regulators. There is also the implication as well, Matt, for the Wall Street banks as well, who have helped, just over the last decade, about 300 Chinese companies raise about 82 billion US dollars. But really, since this pivot change, and it comes with DD in July, since that moment, you've seen just one Chinese company list in the US, more than 20 list in Hong Kong. So good news for the Hong Kong markets, mainly the mainland markets as well, but pretty bad news for Wall Street bankers.
Yeah, those advisory fees could be taking a hit. Thank you so much to Bloomberg's Tom McKenzie. And now let's get back to the U.S. markets and take a look at some stocks moving in pre-market trading. One of the big ones to the upside is Merck. Of course, it has a COVID-19 therapy. And yesterday, a panel of FDA advisors said the benefits of that outweigh the risk. It was a bit narrow, that vote, but nonetheless, you are seeing the stock reacting to it this morning, up about 5.3% in early hours. And while a maker of a COVID-19 treatment is doing well, a number of COVID-19 vaccine makers are doing poorly this morning. Moderna, one of the biggest underperformers after falling more than 4% yesterday. It's down another 3.5% before the bell this morning. A lot of concern about how effective its inoculation will be at protecting against the Omicron variant. And another mover to the downside is Salesforce. This is after it reported earnings after the bell yesterday. Both its top and bottom line forecasts missed expectations. And in other news, they have appointed a co-CEO, Brett Taylor, who will sit alongside Mark Benioff. That stock is down about 6% in early hours, Anna.
Yeah, really interesting. Other enterprise software makers here in Europe not feeling the downdraft from that messaging coming through from Salesforce. Interesting lack of transatlantic read across. Right, let's turn to FX markets. And coming up, we're going to be talking with Derek Halpenny, MUFG, head of European Global Markets Research. We'll talk about global markets, but also home in on some of the interesting FX moves we've had of late. And we're live from the World Aviation Festival with the CEOs of JetBlue and Breeze Airways. Plus, the OECD chief economist Lawrence Boone on their latest economic outlook. That is at 6 a.m. at New York time, 11 a.m. here in London. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller in Berlin with Kailey Leinz in New York and Anna Edwards in London. I've got a chart here which I will walk our radio listeners through. It shows the market pricing of the change, expected change in central bank policy. I've got the yellow line representing the Bank of England, which is fairly unchanged. The blue line representing the European Central Bank, which actually has dropped. So expectations for rate increases have gone lower and continued in that direction since the Omicron scare. The interesting line, though, is the white one. It's the Fed, and probably the most important, let's be honest. It continues to rise here, especially after Jerome Powell yesterday really changed his tone and I think surprised market participants, as was evident in the huge moves that we saw in the curve, in the equity markets, etc. Joining us now is Derek Halpenny, head of research at MUFG. And Derek, what do you make of Powell's change in tone? You know, he put out his published remarks, didn't really mention anything about tapering, but he was concerned about Omicron. And then he shows up live in front of the Senate and all of a sudden says, we got to bring tapering forward and forget about transitory.
Well, I think if you put Omicron to one side just for one moment, and you look back to the week before the emergence of Omicron, when we had Vice Chair Clarida, we had Governor Waller, we had Mary Daly from San Francisco, we had Raphael Bostic, all saying the same thing, which was basically, we need to speed up tapering. And the markets then were pretty much priced for that last Thursday. So I think Powell basically stuck to the script. This is like a speech that was written before last Friday, and he's decided to stick with it until we have enough information about the variant to make a clearer call. And if it's going to be a bigger hit to demand, well, then the Fed can pivot dovishly. But that's not Derek, the time now.
Derek, Powell didn't stick to the script in some ways in that he has been very, very firm on his transitory messaging. And yesterday he says, actually, we need to retire that word because this is much more persistent than we anticipated. And Bloomberg opinion columnist Mohamed El-Arian wrote in a column this morning saying that such a late wake-up call to the reality of inflation actually increases the risk of mismanaging the policy catch-up process, exposing the economy to a higher risk of an unnecessary Fed-induced slowdown. Do you think that the risk of a policy mistake by the Fed is now more elevated?
Well, if you consider market moves over the last couple of weeks in terms of the 2s10s Treasury curve down 40 basis points since the middle of October. We've had crude oil prices now down 20%. We have metals down between 10 and 15%. We have steel prices down. You look across, you don't see a financial market that is fretting about the risks of inflation going forward. Break-even rates as well, generally down 25 basis points in the US. So I think right now, as we sit here today, yes, of course, inflation concerns are still elevated, but getting rid of tapering is an important first step, which I think the Fed clearly wants to do. But the retirement of the word transitory, if you take it, it was said in the context of it's become a bit confusing. We need to get rid of it. But his message about his view on inflation for next year was still that inflation was going to come down quite dramatically.
Okay. Okay, that's important. That's interesting, Derek. I mean, we could have been sitting here with a very different, risk picture, couldn't we, this morning? Because we saw risk assets sell off as a result of concerns around Omicron, but also what we heard from Jerome Powell in Washington. Today, we have a really different look to things. It's really risk on, and I'm sort of trying to work out why that is and whether the market is taking its clues on Omicron from the right places. Are we looking to the right voices to tell us what we need to know about a medical situation?
Yeah, like clearly, look, we're in an information vacuum.
Yeah.
And I think that's why Powell didn't really pivot dovishly. I just don't think it would have been right because he doesn't have the information one way or the other. So he stayed on the course that I think the Fed were already on.
Well, it wouldn't have been a pivot, would it? He's already dovish to begin with.
Well, he was, but as I said, the comments up until last week were hawkish. Let's speed up tapering. The markets were fully priced for a speeding up of tapering last Thursday, and it was Omicron that changed that, not Fed communication. So I would really stress that. I think risk, yes, like obviously I think anyway, a view has been made about Omicron possibly not being as severe. There has been some sporadic reports that that's the case. But of course, we don't really know. And of course, if that changes, then what happened today in terms of risk appetite, we're definitely vulnerable.
OK, and let me talk about something else that's been volatile of late, and that is the Turkish lira. We've heard comments from the president there. We've had FX intervention in the currency market, and that did support the Turkish lira a little while ago. But now we've got incredible volatility. The Turkish lira gained. It almost came back to the flat line. Now it's gaining again. I was drawn to one line, which you might appreciate, Derek, because it reminded me of the 1960s here in the UK. Real wealth is not related to money's exchange rate value, so says the president in Turkey. And I wonder where your view is on Turkish assets at this point, because clearly you have a president here who has really strong views on what interest rates should be, and the inflation story we know about, high inflation.
You know, I think one element is that about 55% of Turkish households are in dollar-denominated cash. So that is an important aspect. And I think that's obviously accelerating now, I would guess. But, you know, the policy mix is eroding values of assets in real terms. We're having inflation up at 30%, possibly even more, if dollar lira continues to move higher. And when you have, on the one hand, saying we're going to cut rates, when you have financing needs with a current account deficit of 3.5% of GDP, yields globally starting to rise, and you're cutting rates, you know, this intervention is just not going to work.
It's not going to touch the sides.
Dollar Turkey went down 4.5%. I'm not sure where we are right now, but we've clearly rallied back up. And, you know, it's such a mismatch of policy.
Are we just watching a train wreck, Derek?
Well, I think we go forward and we continue to move higher. And ultimately, it's about the squeezing of that current account deficit, which, as I said, is about 3.5% of GDP. And that means growth going forward is not going to be particularly favourable. The growth profile after the currency crisis in 2018 was very, very poor, with sharp decelerations in growth. And I have no reason to think this time will be different. So we need to get to a balanced current account position, and that means a contraction in domestic demand. And ultimately, that's when you get back into balance and maybe you reach some form of equilibrium.
All right, well, Turkish lira right now, 13.06 against the U.S. dollar. Thank you so much to Derek Halpenny, head of research at MUFG. And now let's get the first word news. And Senate Majority Leader Chuck Schumer and Republican Leader Mitch McConnell are still working on a solution for raising the federal debt ceiling. The Congressional Budget Office just issued another warning that the government risks running out of money this month. McConnell says there will be no default, but there's been no sign either side has budged from their previous positions. At the U.S. Supreme Court today, it's the most consequential abortion case in a generation. Justices will listen to arguments on Mississippi's ban on abortion after 15 weeks and will consider gutting the landmark Roe v. Wade ruling. A decision upholding the Mississippi law would give states the okay to curb access to abortion. A U.S. advisory panel has narrowly recommended approval of Merck's coronavirus pill, but only after a lengthy debate about the safety of the potentially game-changing treatment. The pill is intended to treat mild to moderate COVID in adults at risk of developing severe illness. And Tel Aviv has moved past Hong Kong and Singapore to become the world's most expensive place to live. That's according to the Economist Intelligence Unit. The soaring Israeli shekel and price hikes for food and transport were the main factors in Tel Aviv taking the top spot. Singapore and Paris tied for second. Zurich and Hong Kong round out the top 5. And Matt Miller, number 6, New York. How lucky we are.
Yeah, it is quite expensive, as someone who's preparing to move back can attest to, but I'm sure you have grown used to it. And I think that's an important point to make. When you get used to it, it's not as bad as when you have to change to it.
Yeah, you get used to it, but then when inflation kicks in once again, you're reminded of it, aren't you? And that certainly feels like a global story these days. Now, coming up on the program, we're live from the World Aviation Festival with the CEOs of JetBlue and Breeze Airways. We will talk about how the sector is holding up to the latest headwinds. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. And it seems from our European experience this morning, Matt, and the Asian experience as well, global markets putting aside concerns about tighter monetary policy and focusing on, well, maybe Omicron won't be as bad as we thought.
Yeah, absolutely. I think every market participant that we've spoken with in the past couple of days has said, of course the proof is in the pudding. Of course we're taking the milder comments with a grain of salt. Of course we want to see the scientific evidence. But having said that, we don't think this is such a big deal, and we're taking that view. Now, you did see markets come down hard yesterday, and I think that was mostly due to Jerome Powell seemingly changing his tone, although Derek Halpenny made a really good point a couple of minutes ago. Even though Jerome Powell is throwing out the transitory word, and much is being made about that, he still is sticking to his inflation expectations that it comes down drastically next year.
Yeah, absolutely. And he did also make the point that if Omicron did turn out to be something much bigger than is currently priced into markets, then things might change. Even Fed outlooks might change. Kailey, what are you looking at ahead of the start of U.S. trade?
Well, markets are trying to figure out what to make of the language change as well, and looking ahead to the jobs report on Friday, and then, of course, that Fed decision coming up 2 weeks from today on December 15th. What does it all mean for risk assets? What it means this morning is that we are seeing a nice bounce after yesterday's losses in Europe. The stock 600 up about 1%, and that's a similar move here when it comes to S&P 500 futures, up 1.2% or so with 4 hours to go until the opening bell. You are continuing to see moves in the bond market. The 10-year yield is up the better part of 5 basis points this morning. We're just shy of 150. 149.36 is where we sit at the moment, and you are continuing to see that flatter yield curve as the front end prices in quicker Fed tightening. Of course, the 5s30 spread now sitting south of 61 basis points, 60.65, which is the flattest that curve has been, going all the way back to March of 2020. And as for some stocks moving in pre-market trading, you are seeing a nice rebound too for some of the travel complex. Of course, these stocks have really been caught in the flux as the market tries to digest what exactly the Omicron variant and the different restrictions being put in place actually mean for the sector. But at the moment, you are seeing the likes of Carnival Cruise Lines, Norwegian Cruise Lines higher by about 3%, and seeing a nice lift for some of the airlines as well. United up 2%, as is American Airlines. American looking to snap a 5-day losing streak, Anna.
Very nice. Let's stick with the aviation theme, keeping our focus on travel and the impact of the restrictions put into place due to the Omicron variants. EasyJet CEO Johan Lundgren said there's been an impact on short-term demand, but the variant hasn't yet derailed a recovery in air travel. I spoke with him yesterday.
We always thought that this winter was not going to be straightforward. Whilst there's an underlying recovery, we always knew that there was going to be uncertainty. So we think that this year, the financial year that we're in, is going to be a year of two halves, where there will be uncertainties over the winter, which is now an evidence, an example of that, what we're seeing. But we also believe there's going to be a strong pickup into the summer.
The EasyJet CEO there with the impact we've seen already. Let's go now to the World Aviation Festival. It's underway here in London. Incredible timing. Bloomberg's Guy Johnson is there on the ground for us with a serial airline entrepreneur. Guy.
Yes, David Neeleman is the current CEO of Breeze, which started 5 months ago, but he has some experience in this industry. He set up JetBlue, he founded Azul. He has a long list of airlines that he's been associated with and has started. Who better person to talk to about what is happening in the industry right now? David, thank you for your time today.
Thanks, Guy. Thanks for being here.
We haven't seen the kind of restrictions that we're seeing in Europe and the United States. Therefore, you haven't seen the kind of impact, I suspect, in terms of bookings. Are you expecting, though, to have a fairly bumpy winter watching what is happening here in Europe?
No, I'm not. I'm really, I mean, this Omicron thing's really new, but I'm pretty heartened about what I'm hearing just in the last few days. I'm always a positive person anyways. You have to be in this industry, but, you know, I think, you know, I think the U.S. has been through the worst of it. I think we've got 75% of the people vaccinated. Just seeing reports just now that, you know, vaccines are working with Omicron and it's seems to be less virulent. Yep. So, assuming that all holds true, I think things are just going to continue to improve in the U.S. and you know, we're feeling really good about it.
How are you feeling about Breeze right now? It's an airline that you've only just set up. It's kind of only been up and running since May. You're waiting for Airbus's new 220s to arrive. That will be a major fleet expansion for you. You're flying legs that other people aren't. Right. And that's the kind of secret sauce of the airline. Right. So how's it going? What kind of load factors are you seeing? How interested is the flying public in what you're doing? Are you profitable?
Well, you know, we're doing great. I mean, we launched with We have 16 cities, we have 39 routes, we have 13 airplanes. We're flying over the Thanksgiving holiday, all-time records in load factors. We were full, basically, in the 90% load factors. On a per-flight basis, we're profitable. I think most importantly, and what gets me most excited about the business, is we do net promoter scores every day. We know exactly how the people are reacting, and we're getting net promoter scores that I've never seen before. In the high 70s, low 80s, because people are just so appreciative to be able to fly nonstop. They haven't been able to fly nonstop on the routes that we're flying, and so they're flying more. They're excited about the fares. They're excited about the convenience, and our people are doing a great job serving them, on board the aircraft.
Many would argue it was an interesting time to launch an airline, but you've clearly seen an opportunity. How big does this model get? How big could Breeze get? A lot of people are already wondering, for instance, what's the exit plan? Is an IPO possible? Is it something that we should think about? How is this story going to work out?
Well, our markets, we're studying 400 markets right now. I love sitting down with our schedule planning folks and looking at their plans going forward, not just for the E-jets, but for the, as you mentioned, the 220s that will be decidedly longer routes. And so, I think it just has, potential. I remember when, Ryanair started, everyone thought they were going to be this big, and now they're talking about flying 100 million people a year, and you're like, how could that possibly happen? Well, you do it through stimulating traffic, and so, we think the demand's huge. As far as an IPO, we're the most highly capitalized startup in U.S. aviation history. We've raised about $300 million. We've got a long runway ahead of us. We have no urgency to go public, so that time will come. We just need to take care of our customers and take care of our crew members and our customers.
David, it's Anna Edwards here in studio. Good morning to you. You made the comparison yourself there with Ryanair, and you talk about your model stimulating traffic. We've just been through weeks of heavy climate coverage here in the UK with the COP26 conference taking place. What does the future of aviation look like with that in mind then? Is it alternative propulsion? Is it other aviation fuels? And how are you approaching that question?
Well, it's all the above. We've got to do some sequestration of CO2. We've got to plant some trees. We've got to figure out how to get some aviation fuel using technology and maybe with some government support, from renewable sources. So, it's going to take some time, but, obviously, there are a lot of industries that can do it a lot quicker than we can. But working together with government and a lot of technologies, the goal is to have it all carbon neutral by 2050, and that's what we're working towards.
David, you clearly think there's a gap in the market for your business, and from what you've said, you're proving that there is one, and you want to expand. You've put your emphasis on kindness, though. What do you think is not kind about the existing aviation sector in the US?
Well, we want to be the world's nicest airline, and it's something we can deliver on. No matter what's going wrong, if we tell every single person that works for us that we're the nicest airline and we just want to be nice every day, then we can do that. And like I said earlier, the NPS scores are really showing that it's working. So I just wanted to do something we could deliver, and that was the easiest thing to do. It really cost us nothing to be kind to people.
Okay, nice. I like nice. Good luck with that strategy. Thanks very much to the Breeze CEO, David Neeleman. Also, thanks to Bloomberg's Guy Johnson, of course. He'll be back shortly with more interviews from the Aviation Festival. We'll be coming back with that, in fact, next. JetBlue CEO Robin Hayes will be speaking to us. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later on today, former New York Fed president and Bloomberg opinion columnist Bill Dudley. That's at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in Berlin and Kailey Leinz in New York. Now, let's return now to the World Aviation Festival then in London. Bloomberg's Guy Johnson is back with the CEO of JetBlue. We've seen US headlines around tightening rules, Guy, on international travel. I wonder how the domestic story is playing out.
Yep. Well, JetBlue now does both. In fact, it's done both for a while. It has had, obviously, some international legs, mainly heading south into the Caribbean. But we now have the North Atlantic route as well, which received a significant pickup on November the 8th when the US dropped a lot of its requirements for international travelers entering. Robin Hayes is the CEO, so let's kind of...
Hi, Guy. Great to be here.
Hear what's going on. Well, Anna brings up the issue of what is happening with international travel. You launched the North Atlantic. You then saw the reopening of two-way traffic. What's been the experience over the last few days? Has Omicron, such a hard word to say, had any material impact?
It's a bit early to say. We had a very strong Thanksgiving in the US. It's a very important time for the US domestic market. It's a very important time for leisure airlines like JetBlue. We had a very strong Thanksgiving. The operation performed extremely well. In fact, I was very proud we didn't cancel a single flight over the holiday period. We got people to where they want to go. And, at the moment, obviously, this new variant's only a day or two old, so very early to see what impact, if any, it's going to have.
In terms of how you think people's behavior has changed, do you think we've got to the point now where people are, yes, there's a Delta surge, yes, case numbers are rising, but unless the government says you can't fly, then most people actually are going to continue to fly. Has the consumer mentality shifted, do you think?
I think so. I mean, I feel the vaccines have been fundamental in people's confidence to fly. We've seen a very significant recovery in the US market. JetBlue flew as much capacity in Q3 this year as we did in 2019. Our airplanes were full. So I think that obviously there's a bit of a question mark that has been created around the new variant. I think that over the coming days and weeks, if people get more comfort that the vaccine works, the vaccine's going to hold, I think we'll keep moving through it, and we shouldn't see too much of an impact to demand.
Do you think it will, though, affect people's desire to book further out? Once again, what it has proved is that there's a lot of volatility in travel, and that is likely to continue. Do you think, therefore, people will say, yes, I want to go, but I'm going to book it 4 or 5 days in advance? And if so, if that continues, what impact is that going to have?
We haven't really seen much of that. I mean, in the US, certainly, a lot of the hotels, a lot of the resorts have actually been filling up very early. So if you don't actually book early, you may not get where you want to go. You're certainly not going to get the best price. So I'm not sure if we're going to see that yet. Certainly, for example, our Blue fare, which comes with no change and cancel fees, we've seen a lot of interest in more flexible products like that. We've seen a lot more interest in travel insurance than we've seen in the past. I think people are thinking about that, but they know that for the most popular destinations, you still have to book early.
Robin, good morning. It's Anna here in the studio in London. It's thinking about that and thinking about where people are prepared to spend their money right now and the extras. Is the low-cost model threatened at all by customers maybe wanting a little bit more service these days? They're a bit more fearful about whether their plans will go according to plan or whether they'll have to change them. Maybe they want a little bit of pre and post service, which the low-cost models have not historically been the best at offering. You might disagree with me on that one.
Well, Anna, that's a great question for the CEO of JetBlue, because what I'm going to tell you is that we're about low fares and great service. So when you fly JetBlue in the US, you not only get a low fare, you're going to get free live TV, you're going to get free Wi-Fi, the most legroom of any US airline. We don't think people should have to choose. And so to your point, in this type of environment, I think people are looking for not just a low fare, but they want, they're looking for a good experience too. They're looking for some extra space, and we're able to provide that for them.
Yes, but they're also looking, my point was really more about getting through on a phone line in an emergency to try and get help with unexpected changes to government regulation. But tell me about that. But also, I'm interested in what you were saying to Guy about your bookings being resilient, because I spoke to the CEO of EasyJet, and I know that revenue management systems, they compare bookings minute by minute, hour by hour, versus where you would expect them to be. Have you seen any drop-off at all since Thursday, since we started talking about Omicron? Any evidence in your booking systems that people are nervous?
No, I mean, in the US, obviously it was our Thanksgiving holiday, so the weekend after Thanksgiving tends to be more busy with people traveling than booking travel. So it's too early to say at this point whether we've seen a an impact or not. And yes, I think that more as what we have seen as COVID levels start to increase again, people get put into quarantine. They're looking to change their trips. You can do most of that online these days. But if you do need a call, we have, like other airlines, seen some elevated wait times. We're hiring hundreds of people to bring those back down.
WTI, as we speak, 69.33. It's come off its recent peak, but oil prices potentially could be going even higher from here. How is that affecting your planning? How is that affecting your route management? Does it make some routes uneconomic? How do you see the fuel story developing? You don't hedge.
No, we haven't hedged for a number of years, and we're used to fuel moving around in this range. We take a fairly conservative view anyway to what the price of fuel is, because you don't certainly want to be making quick changes to routes because fuel goes up. So we feel comfortable in the sort of the range that we've seen. If it does start to go much higher, we'll obviously have to review that. But as a low-cost carrier, we try and keep our fares as low as we can, even in a high fuel environment.
Thank you so much. Thanks to both of you. Thanks very much to the CEO of JetBlue, to Robin Hayes. Thanks very much to Bloomberg's Guy Johnson, of course, bringing us these interviews from the London Aviation Festival. Thanks to both of you for that. And Matt, you've been quite critical, I think, of some of the measures we've seen governments introducing around trying to stop the spread of the Omicron variant. But it is interesting to see how this is going to get into people's psyche or not. And it seems we're getting different pictures from different sides of the Atlantic right now. The EasyJet CEO saying it is affecting bookings, and they're a different message from JetBlue.
Yeah, well, I mean, I want to point out, I haven't been critical myself. I've just been talking to doctors like Amish Adalja from Johns Hopkins who have said there's no scientific reason that you would now block flights coming in from South Africa. It's purely a populist political move. But it's about slowing it down, isn't it? It is politics, but it's also about slowing things down, though, isn't it, Matt? Look, I'm not a doctor. I'm not a virologist. I'm just telling you what a doctor told me. Yeah. So, take it for what it's worth, I guess. It depends on how much stock you put in science.
Yeah, I mean, markets looking around for any clues on Omicron, and just as aviation bosses, I suppose, Kailey. But interesting conversations to have around aviation this hour. Coming up on the program, more from the World Aviation Festival. The CEO of Virgin Atlantic. That's at 8:30 a.m. at New York time, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Anna Edwards in London and Matt Miller in Berlin. And also joining us now, how lucky we are, Tom Keene, co-anchor of Bloomberg Surveillance. And what I know Tom wants to talk about is volatility, because Matt, it's so interesting. On Friday, Black Friday, you had a huge dip. It was bought on Monday. Then you got another dip yesterday, and it's being bought again this morning. It's just a pattern, Tom, and volatility is reigning.
Yeah, it is. The volatility's there, and I rarely do this, but I'm going to run a chart 2 days in a row because this is a nice litmus paper of the system, maybe linking in the equity market, the Standard & Poor's 500 implied vol, the VIX, I should say, and also the bond market as well. The peak out, the angst on Friday, the white circle, down we go to some good news. We go back up with yesterday's angst, and Matt Miller, we come right back down today, really right near the enthusiasm we saw 2 days ago.
Yeah, I feel like I saw an implied vol chart on the Daybreak newsletter this morning as well. And if you look out further, then things calm down a bit. So it's really more of a short-term issue. I wonder what you make of Jay Powell's seeming about-face move. There's been some debate, Tom, today about whether he really changed his tone or if he just threw out the term transitory and still continues to stick to his inflation view.
They're managing the message forward. I don't think the dots really matter here, Matt, or the parlor game as it's played in America. Frankly, the other central banks maybe do this better than the Fed does. But what I will say is they're slaves to the economic data, and that starts with Friday's jobs report.
Yeah.
Imagine this debate if we come in higher than 500,000 non-farm payrolls, and a lower unemployment rate. I'm not predicting that. I'm saying that outcome would lead to a renewed dialogue.
Yeah, it'll be interesting to see if good news on the labor front on Friday actually turns into bad news for the markets. Thank you so much to Tom Keene, co-anchor of Bloomberg Surveillance. And now as for what else we're watching today, I am watching, no surprise, Fed Chairman Jerome Powell and Treasury Secretary Yellen testifying day 2 on Capitol Hill. This time they're facing the House Financial Services Committee. And it'll be really interesting, Matt, to see if we get more changes in Powell's language. Does he care that he upset the markets with his shift yesterday, or does he stick with the fact that, yes, the Omicron variant may be a concern, maybe a downside risk out there, but at the moment, what the data is telling the Fed is we might be able to tighten sooner, or at least taper quicker.
He seems to be staying pretty well away from Omicron, but he does want to throw away the term transitory. I think it'll be interesting if he tries to reiterate his inflation views and actually comes out and says what Derek Halpenny told us, which is that, look, I'm just getting rid of the term because we've wasted so much time on what transitory means, but my inflation views are the same. I think that would be really interesting. I'm watching the virus new cases shot up another 50% here in Germany overnight. We're expecting to be locked down again by Thursday. Is tomorrow Thursday already? Is tomorrow Thursday?
Yeah, it is.
I'm watching days of the week then. Let me change what I'm watching. I can't believe we're so late in the week already.
I can't believe it's December.
It's still just the start of Wednesday stateside, though, so let's not write off a whole day, Matt. You're watching the virus. I'm watching commodities. Could Team Transitory still be alive or make another reappearance? I hate to add that complexity into things, but the oil price in a bear market now, and the broader commodities picture, according to our Markets Live team, has been looking weaker of late. So could we be talking about that once again? More Bloomberg Surveillance is ahead. This is Bloomberg.